Hi, I'm Al Brooks, and this is my price action trading course, the 2014 edition. This module is entitled, What is Price Action? So what's new for the 2014 edition of the Brooks Trading Course? Well, I've been taking questions every day for years, both in my trading room and on the website, the end of the day section of the website, and certain types of questions keep coming up. So I decided to try to address those questions by making changes to the trading course. And the course now has about 200 new slides. I have much more about trading channels. The slides go into just about every module in the course. I've also included that hour-long Forex mini trading course that I presented last year. When traders start out, they want to know if they can become profitable. I believe that most successful traders have a good understanding of price action, and most of them use price action as the cornerstone of their trading. They may use other things as well, but I think price action is absolutely critical to trading profitably. The key to price action trading is to understand support and resistance, and there's much more to support and resistance than simply trend lines and prior highs and lows. The computers that are trading the market, they control the market, see all kinds of other types of support and resistance, and they have algorithms designed to structure trades around support and resistance, betting either that it will hold and the market will reverse, or that it will give way and there will be a breakout. Now, for a trader to be a successful price action trader, it's critical to understand breakouts, trading ranges, and the market cycle. I talk about the market cycle throughout the course, and everyone knows that the market is either in a trend or a trading range. And if it's in a trend, it will soon be in a trading range, and if it's in a trading range, it will soon break out into another trend, and that is the market cycle. And I will talk in detail about this throughout the course and how to identify exactly where the market is in the cycle. And once you have identified what the market is doing, I talk about how to trade in that particular market condition. I'm using this slide to illustrate a fundamental point about charts, and that is that they represent what's taking place in a market. In a market, there are institutions buying and other institutions selling. This is a Forex market chart, the euro versus the dollar cross on a 60-minute chart. And if you just pay attention to websites that tell you that you should be buying a pullback in a bull trend when there's a good bull signal bar here, or here's a third time, you will lose money. There's much more to it than that, and anytime you think that it's a good time to buy, you always have to remember that there is an institution or many institutions who believe the exact opposite of you. Here's an example. We have a bull breakout, but a failure, a bear reversal bar. And you can say, well, I'm going to short this bear reversal bar. We'll get more lower highs, lower lows, and I'll make money. Well, in fact, because of the strength of this breakout, when I see a bar like that, I'm placing a limit order to buy its low, looking for another leg up. And over here, I'm not buying these bull bars, despite them being pullbacks in a bull trend, because the channel down is just too tight to buy. And I will discuss all of this throughout the course. The point is that trading is not as simple as it seems, and just because you see good bull bars in a bull trend or a good bear bar in a bear trend does not mean that the market will go the direction that you think. There will be institutions who believe the exact opposite, and throughout this course I'm hoping to explain to you the situations when the market might be doing the opposite of what you might conclude by just looking at the candles. Price action is any representation of price movement, and it's on any financial instrument, stocks, futures, bonds, it does not matter, and on any type of chart, a bar chart, a point and figure chart, a volume chart, a range chart, a Renko chart, a candle chart, and it can also be on any time frame. So for example, on a candle chart, a 1-minute chart, a 5-minute chart, a daily chart, a monthly chart. Any movement on any of those charts is an example of price action. And price changes with every tick, and each change becomes an example of price action. When you're looking at charts, some things look very minor at first when you're watching them, but you should not dismiss anything. Everything that happens is happening because a group of institutions are making it happen. And our job is to follow what the institutions are doing. And if they're able to move the market, then you have to assume that something is significant happening with every tick up or down. So sometimes things look very unimportant, but they can lead to great trades. I believe that price action is genetically based. It's a reflection of human behavior, and our behavior is controlled by our genes. And I've looked back at charts for over 100 years, and the charts are the same. The price action on the charts are the same as they were long ago. And since I believe price action is a manifestation of human behavior and our chromosomes, it will continue to remain valid until we become a new species. I believe that the markets are controlled by human behavior, and I think the behavior is genetically based. So I think price action is based in genes, in our chromosomes. And as long as we remain the same species as we are today, the charts will remain the same forever. For example, here is a weekly chart of the Dow Jones Industrial Average back at the time of the Great Depression. And if I did not have labels on this chart, you would not know that it was a chart from 80 years ago. You know, here we have a spike in channel bear, we have a measured move down, we have a breakout test of a breakout point, we have a measured move up, we have a higher low major trend reversal, a wedge bull flag, a triangle, a double bottom, a wedge top, a two-legged correction, final flag here, a wedge bear flag here, a channel here with a failed bull breakout and a reversal. I know I'm using terms that you're probably not familiar with, but these are things that I will discuss throughout the course. The point of this slide is that the charts are the same as they were long ago. I've looked at charts from over 100 years ago, and if I remove the labels on the chart, I cannot tell them apart from charts today, even though most of the trading today is done by computers. You know, I believe that price action is simply the way the market responds to a collection of buyers and sellers, each trying to make a profit. And computers are simply automating the process. They're trying to maximize their profit. They're trading off probability for reward versus risk. I talk about that as well. You know, traders are either taking high probability trades, which means they have to have a smaller reward compared to risk, or they're taking big reward trades, trades where the reward is very big compared to the risk, and those trades are much lower probability. And all trading comes down to choosing between one of those two approaches. Either you're favoring probability and you're trading off reward and risk, right? So if you're going for a high probability trade, you're going to be going for a smaller reward relative to risk, or you're going to be favoring reward. You're going to be trading looking for a big reward relative to your risk. Chances are you will not succeed. So in other words, traders going for big rewards are giving up probability. And I'll be talking about that throughout the course, and that is the essence of trading. At any given moment, someone is taking the probability side of a trade, and another institution is taking the reward side of a trade. But the markets are the same as they always were, and professional traders, they trade every market. I believe almost all successful professional traders trade all markets the same, and they don't pay attention to what the market is, what the time frame is, they're looking at the price action. This is another illustration of that. Here are three charts. Now, one of these charts is a daily chart, one of these is a 5-minute chart, and one of these is a 1-minute chart. And with the legends removed, you cannot tell which is which. Also, one of these is a forex market chart, one of these is gold, and one of these is a stock, General Electric. And their time frames are very different. One's from 1987, and then the other two are from more recently. But this illustrates the point that it does not matter what the time frame is, it does not matter what the market is, and it doesn't matter when the chart took place, whether it was 25 years ago or today, traders are going to be trading them the same. Crashes are common. 1987, most of us were around in 1987, and this is a daily bar chart of General Electric during the crash of 1987. Big bear spike and then a triangle. It looks pretty much the same as this 5-minute chart of Costco. A big bear spike and then some kind of a pullback. And the same as a 1-minute chart of the E-mini. And you see this every day. The E-mini crashes every day on small enough time frames. So there's nothing special about a crash. In terms of price action, it's the same on all time frames. When you look at articles and websites, it's easy to come away with the impression that candlestick patterns can make you rich. The world is filled with websites, videos, and books that teach candlestick patterns, and the message is clear that if you memorize a group of patterns, maybe a dozen patterns, you will get rich. And you correctly believe that big firms like Goldman Sachs, the high-frequency trading firms, and hedge funds make a fortune. However, they are not using candlestick patterns to do so. They might look at candlestick patterns as one piece in their process of deciding what to do, but they don't use candlestick patterns to any great degree. So what do they use? Well, watch CNBC or any financial television station, and you'll see lots of successful traders every day talking about their trades. And they constantly emphasize things like trends, channels, prior highs and lows. And do you ever hear them say that they sold a bull because of a dark cloud cover or a shooting star or a harami? Of course not. And the reason they don't say it is because they don't do that. Let me give an example of a candlestick top in a bull. And can you make money from it? Yes. Okay, how do you make money from that top? You don't sell, you wait a few bars, and then get long where the candlestick bears are exiting with their losses. Here's an example of a daily chart in Apple, and you have an outside down bar closing on its low. Yes, it's a possible double top and could be the start of a bear trend, but it's a very strong bull trend. The channel up is very, very tight. And when that's the case, no matter what kind of reversal you see, here, 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 and then here, the odds are the best the bears can get is a trading range. The stock market, or any market, is like a super tanker, and it does not change directions abruptly. It usually has to transition. And for the stock market, in this case Apple, normally before the market can go down, it has to transition into a trading range first. And most attempts to reverse will fail. For example, this reversal failed. When it went below this bar, it failed. Below this bar, failed, 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 failed. Okay, failed, right? So that tells you something. It tells you that most reversal attempts will fail. So what are the chances that you'll make money by going short based on this great-looking bear bar? Small. Chances are it'll fail, and the result will be a trading range and then higher prices. Okay, here's the next bar. You say, wow, we got that big outside down bearish engulfing pattern, and now we have follow through. We have another bar with a bear close. The close looks like it might be at or below that low, so some confirmation. Yes, all true, but it's also the bottom of a trading range, and that's probably the best the bears can get. when the trend is this strongly up, usually the best the bears can get is sideways and not a reversal down. And this is what followed, right? It turned out to be simply a pullback to the moving average, and then we got another leg up. So most profitable traders, when they see a bar like this, a big outside down bar, they'll buy that close. They'll buy this close because they're going to correctly conclude that the probability is that the reversal will fail and that the trend will resume. Okay? That's an issue that traders consider all the time. Probability, right? You cannot simply look at risk and reward. You have to take into account probability. And some traders, like myself, prefer to trade in the direction of the high probability. And remember, on any given instant, there are institutions buying and institutions selling, right? If you want the higher probability trade, you buy these bear closes, betting that the bears will fail, and you'll get a leg up. If you want the bigger reward trade, you sell looking for a big move down. Chances are you'll be wrong, but if you sell that close or sell below that low and put a stop up here, you're looking for a test down here. The reward is many times greater than the risk, and that can make up for the low probability of the short. In general, high probability trades are easier to manage, and I tend to prefer higher probability trades. When I say high probability trades, I'm not talking about 70 or 80%. At any given instant, the probability that the next 5 points will be up or the next 5 points will be down is always between 40 and 60%. So the best you can hope for is a 60% chance of being right, and on any given trade, chances are you have between a 40 and 60% chance of being right or being wrong. Markets tend to have inertia, and that means that they tend to continue to do what they've been doing. And just look to the left and see what is likely to appear to the right. So you look at the current bar, and what do you think is going to follow? Look to the left. If the market's been sideways, the bars that have not yet appeared on the chart will probably be sideways. If the market has been going up, chances are the bars to the right will be higher. 80% of tops fail. So if the market's in a bull trend, 80% of the reversal patterns will fail. If it's in a bear trend, 80% of the bottoms will fail and the trend will continue. If the market's in a trading range, 80% of the breakout attempts will fail and the market will probably continue in the trading range. Anyway, back to what I was saying about that chart in Apple. There's much more to a top than a candlestick pattern. Okay. Trading is difficult, right? And traders learn that quickly because when they start trading, they're going to lose money. No matter how hard they try to trade well, no matter how well they know their candlestick patterns, they're going to lose money because it takes a while to accept that there are institutions believing the exact opposite that you believe. Remember, it's a market, and a market means there are buyers and there are sellers. The sellers believe the market's going down, the buyers believe the market's going up. Neither one is more than 60% likely to be right. Neither one is more than 40% likely to be wrong. So probability hovers around 50%, but both the bulls and bears can make money by managing their trades correctly. So at any given moment, you can make money by buying or you can make money by selling. It does not matter. What matters is if you manage the trades correctly. And I talk a lot about that throughout the course. Candlestick patterns are a false god. Okay? After losing enough money, traders seek help. They're desperate to believe in anything, and there are many well-intentioned prophets out there that preach that candlestick patterns are the one road to financial heaven. You know, you look at the websites, you look at the articles, you look at the books, and it's easy to conclude that, oh my gosh, thank goodness I'm being saved. All I have to do is memorize these 10 candlestick patterns and I will make money. And candlesticks can be helpful, but it's a false god. When you start out, you want to be protected. You know, you don't want to lose money. You're really afraid of losing money, and after you've lost some money, you know, you're looking for help. Will somebody please help me, right? Give me something to believe in. Give me a sure thing. And the reality is there is no sure thing because the market is balanced between buyers and sellers. Occasionally it breaks out and runs to a new price level, but most of the time the market is fairly evenly balanced, and the buyers can make money if they manage their trades correctly, and the sellers can make money if they manage their trades correctly. And candlestick patterns are just a very small piece to trading, and I think they're really not necessary at all. A lot of institutions don't even trade with candlestick patterns. They just trade with line charts. All right, so if not candlesticks, then what is price action? Just listen to the traders on television, like on CNBC, and they'll tell you every day. You never hear them mention candlestick patterns. They repeatedly talk about support and resistance. They talk about a pullback to the bottom of a channel. They talk about a pullback testing a prior low. They'll talk about whether the trend is strong, whether it's forming a series of higher highs in a bull or a series of lower lows in a bear. They'll also talk about buying and selling pressure. They don't explain what it is. I talk a lot about buying and selling pressure in the course. But you'll hear them talk about buying and selling pressure. You'll hear them talk about, wow, this trend is really strong. And you'll also hear them talking about probability, risk, and reward. However, a lot of the times you'll hear them talk about risk and reward and not about probability. If you watch shows that talk about with options traders, you'll sometimes hear them touch on probability. And probability is really, really important. You cannot simply talk about risk and reward. For example, every now and then you'll hear an option trader buying a put in a very strong bull trend, and he'll say, oh, I probably won't make money, but if I do, I'll make a lot of money. So what he's saying is his risk is small, the price of the put, his reward is huge, and he knows he'll probably lose money. However, the reward is so much larger than the risk, it can offset the low probability. Trade management is also very important. For example, I said that both bulls and bears can make money. Well, part of what they do is to scale in or scale out of trades. So for example, if you're buying a pullback in a bull and the pullback continues lower, a lot of traders, a lot of successful traders will buy more. And if they manage their trade correctly, trade small enough, use the correct stop, exit correctly, they have a higher chance of making money by scaling into the trade and by scaling out, and taking partial profits at a resistance level and then holding the remainder of the position until the market reaches another resistance level and then taking more profits. Well, you need all of that and more, and candlestick patterns can be useful, but they're really a small piece of the big picture, and they're really not necessary at all. Okay, trading can make you rich, right? However, this is not the way to do it. You know, when I first started trading 25 years ago, this is pretty much what I did. I put many indicators on my charts and hoped that they would make me rich, and I lost money. And one day I decided to get rid of all the indicators and just look at the charts. And this is that same chart that I just showed a minute ago, but without all the indicators on the chart. And when you look at it this way, it looks pretty clear. We have a decent looking wedge over here, and then a bull spike, and then a pullback from the breakout of the wedge, and then a double bottom bull flag, another breakout, and another pullback. So you know, if you get rid of all the indicators and just look at the chart, just look at the price action itself, a lot of times you'll see things that you cannot see when you have the indicators present. And you don't have to look at the 5-minute chart. You can look at any kind of a chart. For example, here's the same chart where there's 1,000 ticks per bar, and the overall shape is still the same. The price action is still the same. Okay, here's another version of the chart where there are 300,000 shares per bar, and again the price action is the same. Here's our range chart. This is a range chart of the same 5-minute chart of Petrobras PBR, and again the same basic structure is present on this chart as was present on the other charts. It does not matter what type of chart you use. All they are is representing human behavior. This is another example of the same thing, this time using the euro versus the dollar cross forex market 60-minute chart. And if you look at ads in magazines, or if you look at websites, they give traders the impression that if one indicator on a chart is good, you'll make even more money if you add a second, a third, a fourth, or a fifth. And for me, that is so wrong, right? This is not how professional traders trade. You can't even see the chart when you have too many indicators on top of the chart. Also, even if you don't have all these indicators on top of the chart and instead you have indicators below, it's still too much to process. And I think most professional traders do not make money doing this. You know, a professional trader might use one indicator, right? But I think most professional, profitable traders trade with a very simple setup. This is much more what traders would use to make money. This is the same chart, again, the euro-dollar cross 60-minute chart, and it's the exact same chart that I just showed, but this is how I trade the chart. I do it with just simple price action analysis. I'm looking at trend lines, I'm looking at support and resistance, I'm looking at wedges, I'm looking at double tops. Here's another wedge, wedge is up here. I'm looking to buy second entry longs. Here's the first reversal up, here's the second entry, and here's the first pullback after a strong breakout. Here, a strong breakout, 5 bars up, 4 bull bodies closing in their top halves, so I'm going to look to buy the low of that bar. And I want to keep it simple. The chart tells me all that I need to know, and it doesn't matter what chart it is. This is a 60-minute chart. It could be a chart based on volume, it could be a chart based on range, it could be a range chart, it could be a tick chart, it could be a 5-minute chart, does not matter. It could be a daily chart, a weekly chart, a monthly chart. I trade them all the same, and I think most professional traders trade them all the same as well. Monthly chart, Petrobras, okay? Again, basic price action is the same. Parabolic buy climax, the final flag, strong bear spike, pullback, test of the low, and there are tradable patterns all the way through the chart. This is the end of the module entitled What is Price Action? This is Al Brooks.